Today I would like to analyze Target, one of the largest retailer in America and one of the worst performing stocks in the last 6 months. We are down around 28%. So they just announced the earnings. The earnings were not really good. And we can see here they expected around 1.61 earnings per share, but they announced around 1.3. Then also the revenue was lower than expected, around 23.85 billion announced, but they expected around 24.27 billion. So overall, this company had a very bad performance. So we're going to take a look at the financials to find out if it's a good buy right now. The first thing we can recognize is a market cap of 42.84 billion US dollar. This makes Target the 6th largest supermarket company in the world by the market cap. We also have a dividend yield of around 4.75%, which we can see here did grow in a very good rate in the last 10 years. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So in 2021, the revenue was around 93 billion US dollar. This was a strong growth around 20% from 2020. Then in 2022, we saw the good growth around 13%. In 2023, we saw the decent growth around 3%. And in 2024, we saw the decline around 1.57%. This is something we don't like to see, but overall, in the last 5 years, we had a good growth, so it's a check here. The next thing we're looking for is free cash flow growth in the last 5 years. So free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2021, the free cash flow was around 7.88 billion US dollar. This was a strong growth around 92% from 2020. So this was related to COVID because a lot of people bought groceries at that time. Then in 2021, we saw the decrease around 35%. I think it's understandable because the year before we saw the incredible growth. Then in 2023, we saw the negative free cash flow. This also has a reason. If we take a look at the capital expenditures, we can see here it was way higher in 2023, around 5.53 billion, and the year before around 3.54 billion. So then in 2024, we saw the free cash flow around 3.82. So overall, what can we say? We didn't have a good growth in the last 5 years, so it's not a check here, but overall it's still a good free cash flow. The next thing we're looking for is a free cash flow yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So let's calculate this number for 2024. We're going to take the free cash flow around 3.82 billion US dollar. We're going to divide it with the current market cap, 42.84 billion. So then we're going to get the free cash flow yield for 2024. So the number we're going to get would be around 8.91%. And this is actually a very, very good number. It's over the 4% and it's an indication for undervaluation already. We can also calculate this number for the next years. We can ask ChatGPT, we get the assumptions for 2025, 4.4 billion US dollar, for 2026 around 2.4 billion US dollar, and for 2027 around 2.7 billion US dollar. So let's assume for 2027, maybe it's very pessimistic, but let's assume around 2.7 billion US dollar for that time. Then we're going to divide it with the current market cap, 42.84 billion. Then we're going to get the free cash flow yield for 2027 with our assumptions. So the number we're going to get would be around 6.3%. And this is a great number again. It's over 4%. It's again an indication for undervaluation. So I think this company looks very interesting right now. The next thing we're looking for is a debt to free cash flow ratio under 5. This means the company can repay the debt with the free cash in under 5 years. A very important number because if the company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first we're going to take a look at the long-term debt. We can see here around 12.28 billion US dollar. Then we're going to add the short-term debt as well, 1.5 billion. This number we're going to divide with the free cash flow that we had, 3.82 billion. And then we're going to get the ratio that we're looking for. The number we're going to get would be around 3.6. And this is a good number, I would say. It's under the 5 years that we're looking for. So it means a little bit over 3 years we can repay the debt with a free cash flow. So the check here, we like to see that. We can also take a look at the cash on hand, how much money this company has in the bank. We can see here around 4.76 billion. And I think this is also a very good amount. They have a lot of cash in the bank. So overall, I think it's a good balance sheet. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So we want to see a low number here. First, we're going to calculate the enterprise valuation. This is the current market cap, 42.84 billion. We're going to add the debt as well, 13.78 billion. We're going to take minus the cash, 4.76 billion. So then we're going to get the enterprise valuation of this company, how much the whole company is worth. So the number we're going to get would be around 51.86 billion. This number we're going to divide with the current free cash flow, 3.82. And then we're going to get the ratio that we're looking for. So the number we're going to get would be around 13.57. That's a great number actually. We want to see that number under 25, and this is definitely an indication for undervaluation. We can also calculate this number for 2027 with our pessimistic assumptions. So this would 2.7 billion for the free cash flow. Then we would get a different number as well. So the number we're going to get would be around 19.20. And that's a good number as well. Overall, I think this is an indication that this company could be undervalued right now. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that, especially if we think the company is undervalued. So we're going to take a look, and what we can see, yes, this company buys back their own shares, sometimes even over 5%, and this is a very good amount. But we also need to consider that in 2022, probably the stock price was way higher and it was more expensive to buy back their own shares. Right now, the stock price is more cheap and it makes more sense to buy back their shares now. So overall, let's still check here in the shares outstanding decrease in the last 5 years. Can Target stock be a good buy right now? One of the worst performing stocks in the last 6 months. We are down around 27%. So let's start with a positive about this company. So we had a good revenue growth in the last 5 years. The free cash flow growth was decent. We had a very inconsistent free cash flow, sometimes higher, sometimes lower. The balance sheet is very good. We like to see that we have a low amount of debt and a good amount of cash on hand. The free cash flow yield is also very high, around 8.91%, which is an indication for undervaluation. Also, with our free cash flow assumptions for 2027 that are more pessimistic, the free cash flow yield would still be around 6.3%, which still is an indication for undervaluation. Our enterprise valuation to free cash flow ratio around 13.57 is also very good. We want to see that number under 25. So again, it's an indication that this company could be undervalued. With our pessimistic assumptions for 2027, this number still would be around 19.20, which is a good number as well. We would like to see as well that we have the shares outstanding decrease. This means the company buys back their own shares. This is important, and this can help the stock price to increase as well. What we don't really like to see is the tariffs. Of course, this affecting the company as well as makes the products more expensive. But overall, I think it can be a good buy right now. If you found this video helpful, don't forget to like and comment and subscribe for more content.